equal. What that means is that price makes all investments, whether it's bonds, stocks, options, different strikes, doesn't matter. They are all equally attractive. Think about that for a moment.
Bill, can you go back one slide? So everybody take a look at this thing here. Let me try and just take a moment to just put it into everyday terms. We've talked about all these terms already, but I'm going to reiterate. Think about the first one as your run-of-the-mill everyday T-bill. And think of the last one. This is Bill. You do this all the time, right? You just use extremes.
Out of the money option.
Right, out of the money option, lottery ticket, way out of the money option. Think of that.
Way out of the short-term out of the money option, yeah.
Think of that last one as you're going to go to the 7-Eleven, you're going to buy a lottery ticket. What are your chances of winning? Nothing, right? Very, very small. You'll pay something because of the allure, because you can win $100 million, because it's sexy, because it's fun, because you like to do the scratch-offs, all kinds of dumb reasons. But you're going to lose, right? Let's just face facts, right? You're going to lose, which is why they say the best way to play the lottery is to not pay it. You're going to walk away with more money, but it's not fun that way. So, start thinking this in terms of, well, should I bet 1 to make 4 or should I bet 4 to make 1? With regards to the probability of the win, not with regards to the dollar or the $4 that you're betting, but with the probability of winning something on the other side, as part of the trade or as part of the equation.
Absolutely. So again, see, that's the catch that people miss. They are all really the same. So let's go back to our investments that we saw, our little assets in our little market here, with our prices, the price of the asset and the rewards. So Stu, which one of these is better?
We don't like to use the word better, Bill.
That's a good point. Yeah. And this is why. This is exactly why I tell people you can't use better, because the market has priced in any of those benefits. See, if all of these were priced the same, there's no question the guaranteed game is better. But because of the word better, what do we know would happen to the price? It had to get bumped up. What if it went to 101? Now it's not only not better, it's horrible.
It's horrible. Now you're a guaranteed loser.
So we have to say, once all of the benefits are factored in, that they're all the same. And this is why you, as an investor, trader, speculator, however you want to classify yourself, you have to start with a goal. I can't tell you, we get this all the time in Q&A. Well, which of these spreads is better? Which strikes would be better? I don't know.
Yeah, I'll let you know, next week.
I'll let you know once they expire.
I'll let you know after I see if Bill pulls the ace of spades. I'll let you know which one was better.
Right. So the thing is that they are all equally attractive in terms of risk. Now, they might not be equally attractive to you, depending on what you're trying to do. But that's missing the point. They are all equally attractive in terms of risk because they have been priced according to risk. Now, once you understand this, you're going to see a lot of fallacies in the market. One of my favorites, Stu, minimize risk and maximize reward. We hear this all the time. It might be a trader who says, oh, this strategy will minimize risk and maximize reward. Or one of these YouTubers out there, our secret methodology minimizes the risk and maximizes the reward.
I just had a session yesterday with a gentleman who indicated that he was interested in a trade that had minimal risk
but lots of reward
and maximum reward. He was actually talking about the strategy.
There you go.
Fly, which you kind of get in for next to nothing. That has a giant reward.
Right. So now all of you out there on YouTube can figure out, not just because one person says it can be done and another person says it can't, you will now know for yourself why this cannot happen. You cannot minimize one variable while you're maximizing another. You get your choice. Because if you could, let's go back to our market, you could get this reward. This is the maximum reward, and there's the minimum risk. So somebody says, I want to minimize the risk. They're saying I can play this game, but I can get this reward for you. I can get the maximum reward. It's not ever going to be priced that way.
See, people think that the People think that it's an equal 50-50 shot no matter
what. They assume the probabilities are equal, right?
That's what I was trying to say. They assume the probabilities are equal no matter what the bet is. But the market has a way, in football, we talk about that, the point spreads, the odds on a horse track.
Equalizer.
The market has a way of taking care of all that in the making of the market. It takes care of the odds. I think you were talking about it today, right? You say every day you like to bet. I don't forget what team, like the Miami Dolphins. You bet the Dolphins because they're a good team. You bet the Dolphins. Now all of a sudden, the Dolphins are giving up 21 points against the Bills. You still going to bet the Dolphins, right? Things change, right? You gotta be able to say, like, it's not equal anymore, right? They're not the same team. It's now I'm behind.
So there's always a way to equalize anything. And that's one of the things that, as Stu said, with the point spread in football. Doesn't matter. You could take a pro team and a high school team, and you could make it a fair deal by giving them an outrageous number of points that the pro team, just because there's not enough time on the clock, could ever catch. So there's always a point where you can equalize those.
There's always a price.
And that's what the markets are doing. So that's another way to understand why they're equalized. Now,
that's why we as traders, that's why we look at implied volatility. Because the number that you look at, what's this option? This one's 5 to 5 1/4. That doesn't mean anything to me. There has to be some sort of equalization process to tell me what that $5 represents. That's what the implied volatility is.
Correct. Yeah, absolutely true. So here's another thing. Once you understand this risk-reward relationship, let's look at a game maybe where you have a high probability of winning.
Okay.
Because a lot of people say, I want to have maybe a high probability of winning because that's gonna be better. We read this a lot or you hear it on YouTube a lot. We have a 92% win rate, or this strategy allows us to win 92% of the time. What does that tell you? It tells you absolutely zero. And here's why. Stu, I'm going to make a great deal for you. I want you to figure out if this is a good game. We're going to put 10 numbers into a hat, and you are going to win if you draw the numbers 1 through 8. All right.
8 so you can 10 chances to win.
Yep. So you can win, make it $1, make it $100, pick a reward.
Doesn't matter.
And you're now going to win 80% of the time. Do you want to play that? Now, I know what everybody's out there thinking. Well, heck yeah, because I'm going to win 80% of the time. What could be better? If you're thinking that, you fell right back into the trap, because the market will price the benefit. Anytime you say something has a benefit to it, it gets factored in. So let's throw all of these numbers into a hat. What do we know? We can look at something that are called the odds ratios. It's used a lot in gambling. We have 8 ways to win, right? 8 of the numbers were red out of the 10, and therefore you had 2 ways to lose. In that example, number 9 and 10. We can divide these down. We can say that's 4 ways to win, 1 way to lose, and right there is the secret. That's why gamblers look at things in terms of odds. Because of this, we can see that you will have to pay 4 to win 1, because you have 4 ways to win and 1 way to lose.
Right. So now think about it as a guy, or as I shouldn't be gender specific. Think about it as a trader in the marketplace. Do you want to pay 4 1/4, or do you want to pay 3 3/4?
Right.
What do you want to do? Now you have what's termed a fair value.
Right. Somebody could come in and say,
what do you want to do around that?
Yeah, here's a strategy that wins 80% of the time. I don't care. Oh, look, it only costs you 5 1/4. That's a horrible deal. So it's an absolutely horrible deal.
I would sell that till the cows come home.
Sell it forever. So all this means is that if we want to make the reward $1, you would have to pay 4. If the reward's 100, like we did last time, you would have to pay 400. So if you have to pay 410 to make 100, you don't want this, even though you're winning 80% of the time.
Right. It's too much money. It's too much relative
to the risk. You're starting to see, hopefully everybody out there, it's always about the price relative to the probability. It's not just the price. So if we were to do this, if we were to pay for it,
you can play a little game. You can play games with this, and everybody out there, you should do this. Right, take a number away. Right now, instead of 10 numbers, there's 9 numbers. See, that changes all the odds.
Oh, it changes things big time.
Right, that gives you a better probability.
Or add numbers.
Right, or add numbers and see what happens. And then just kind of put that next to the marketplace and see how it's really the same exact thing.
It's exactly the same thing.
And then start thinking about a bet that you're going to make. The question that do you want to bet 1 to win 4, or do you want to bet 4 to win 1? Everybody wants to bet 1 to win 4. Not me. I'd rather bet 4 to win 1. I know I got a much better chance of winning than
right. And that's still a 20% or 25% gain. So here's the thing. If you were to do this over and over for the long run, pay 4 to win 1, what we would call a fairly valued bet. This is a hypothetical simulation of 5,000 attempts at this absolutely phenomenal game. Now you can see that there are times that we lose, sometimes lose big. There are times that we win, sometimes win big. But in the long run, what happens? You are absolutely positively guaranteed to come back to 0. So it's not really a game that you want. It's not really a great deal. And yet a lot of people would, because they'd say, oh, I can win 80% of the time. Not enough information. Now, if the reward is $1 and you can win 80% of the time, that's information piece number 2, and it costs you $3.90. Yeah.
Now you do.
This is why Stu was saying that we would look at volatility. But we have a feeling most people out there don't do that. They just say either A, I can win 80% of the time, or whatever number you want to pick, or it only costs $1 or $2 or $3, and therefore it's low risk. They're just looking at the dollars. That tells you nothing. Tells you absolutely nothing. It
kind of reminds me of, I sold a vertical spread. It went against me. I'm gonna roll it up and out. I sold it at 2. It's now trading at 4. Right. So I'm going to buy it back at 4, and I'm going to sell another one at 4. It's not going to cost me any money. Well, hello. Yeah, it is. You're going to lock in the $2 loss, and now you're going to have something at 4, right? So the 4 can lose if it's a $5 spread. Now the 4 can lose another $1 if it goes against you. Now you're going to sell more. But more importantly, to the tune of what we're talking about here, selling it at 4 is not selling it at 2, assuming all else is equal. That's a bigger risk position.
Yep.
When in order to get those dollars, you have to take on additional risk. It's not the same as when you sold it at $2. You might have had 10 points of distance between your risk line and where you currently are. Right now, maybe you got $3 of distance between you. Well, which one would you rather have? You'd rather have the distance. You got to go back to the $2.
Then you got to go back the other way, right?
Right now the up and out deal is like it's not really working anymore.
Not such a hot deal.
Yeah.
So one more time for a little plug here, Stu. MarketRebellion.com/get started. Again, I can't emphasize a lot of great videos in there, absolutely free, good little mini courses and things to help you get started. Because as you all have probably discovered, there's a lot of bad information on the internet, a lot of great information, but there's also a lot of bad information. So make sure that you are getting, make sure where you're getting your training from. And that's a wonderful place to get absolutely free. So risk and reward, the things we want you to take from this is that risk is not defined by the amount of money in the trade. So if you hear somebody say, oh, I'm only risking $1 to make 4, it sounds like they're not taking a lot of risk. Sounds like a great deal. Who wouldn't want to take a tiny bit of risk and maybe make 4 times their money? See, price is not risk. Risk is a reflection of the probability of making money.
And that's what options are. Options
absolutely.
Are price.
Yep.
Options, you could change the wording and say the options are not options. That's just the product.
That's a product.
Product is putting out probability
and rewards
of some movement in some defined time period, given a set of circumstances, given interest rates, given a dividend, given historical volatility, right? That's what options are. It's just about the probability of the future event.
Yep. And that's why things can get confusing. If you go back to our 3 games, that's why I had to hold the reward constant at $100. What if we made the card game $100,000? Well, now it's going to be priced higher than the others, or $1 million. We could always make it to where it becomes the higher price game, but that doesn't get away from the fact that it's still low probability.
Yeah.
See, that all comes out in the wash. We have to say, what's the reward and what's the probability? And that's why you hear people like Stu and our other market makers and coaches that we have here at Market Rebellion always talking about implied volatility, because that's where the game is played. So if you're out there trading and saying, well, it's only $1 and I can make 4, therefore it's a good trade, you're not looking at this game in the right way. So for example, let's talk about some vertical spreads, Stu. Here's a 90.95. We can tell that because we have our bends. Maybe we've purchased the 90 call and sold the 95.
Expiration graph, the bends are always at the strike. There you go.
Yep, that's our expiration graph. And let's say that the stock is up here right between 100 and 105. So let's call it 102.5.
Uh-huh.
Now, I ran these in a pricing model, and the pricing model said that this spread is worth $4.78, and therefore you could make 22 cents. That's why this blue line up here sits just its little sliver above zero.
And people out there are saying,
why?
That stinks. That's horrible. That's
it's priced according to risk. It's got a super high probability of making it. It's exactly like the risk-free game that we played. Why would they have bid 99 to make $1? I don't know. Why did they bid 478 to make 22? I don't know why they landed on these numbers.
It's all relative. I
just know it's because it's a very high probability. Right.
I can't tell you how many times it was like this. It was a $5 spread that I was able to trade on the floor. That was expiration day. That because of the way the order flow was going, traded at 485 or 490, maybe with a half an hour to go. On a $100 stock that was 100 on a $108 stock that $100 risk line. It's 8% away with 20 minutes to go.
Yep.
I'm a buyer.
Absolutely take that.
I'm a buyer. And if you really want to nail it down, the put spread's trading for a nickel, it's a lock. So
then now it's a lock, right?
Right. So who pays $4.90 to win a dime? When the probability is there that you're going to win, when it's high enough, you are. The trader is.
Or even more importantly, if you understand your options and your strategies, as you said, the prices by themselves might not look good, but in that case, you've got a lock. So on one hand, somebody might say that's a horrible trade, and yet you might be doing it in millions and millions of dollars because why not? But see, they wouldn't see those trades because they're looking at things strictly from the price that they have to pay versus what they can make. It's the wrong way to approach it. Let's take a look at the 95-100. There's our bends. Pricing model says it's worth $3.96, and therefore you could make $1.04. Why did the market make this one cheaper, Stu? It was $4.76. And now they've made it. You can see that the red line sits above, and it's pushed the reward a little higher. Why?
Higher risk.
We've moved closer to the current stock price. There's less of a chance for this to actually come true, to get that reward. What if we look at the 100-105? Now the pricing model says it's 250 to make 250 because it's right there in the center. It's right at the coin flip. It's exactly what we saw in the coin flip. Now in this case, it's really pay 250 to make 5. So because it's a $5 spread, which would be a 250 profit. But what if we bought the 105-110? Now the pricing model says it's worth $1 and it might make 4. And again, this is where people say, gosh, I look at what a great deal. I'm only risking $1 to make 4.
But look where the stock has to go. And
look where the stock's got to climb 2.5 points just to get your long position at the money. Your break even's up here at 106.
Yeah. Yeah.
That's called a very slim chance of happening. But if you word it the wrong way, it looks like it's low risk and really high reward. I'm minimizing my risk and I'm maximizing my reward. You can see where all of the fallacies come in. You're not minimizing your risk. You're maximizing your risk, which is minimizing the price. That's what's maximizing the reward. And then finally, let's try one more, the 110, 115. Pricing model says that is worth 27 cents, and we can now make a whopping 473.
That's the one I want to buy.
I want it because it's low risk and high reward.
There you go. Take it. How many can I buy?
Yep. So hopefully, because we see this all the time, we see it in Q&A. We've been coaching and teaching a long time. We see this all the time. And we hope that it can at least shed some light when you'll start to see this a lot. People that will advertise, we win 92% of the time. Or would you like a strategy that wins 85% of the time? I don't know. What's the price? I need to know the price for it.
Yeah.
That's the thing. Not that it wins. I don't care. In fact, could you make a ton of money on something that wins 2% of the time?
Absolutely.
Sure. If it's priced well above fair value, absolutely we'll take it.
And who defines a ton of money? See, that's another thing. Who defines a ton of money? You know, $1,000 to somebody might mean all the money in the world, but $1,000 to somebody else might mean nothing. So that, you know, that's a relative thing as well, right? Which kind of goes into another topic of size your trades accordingly, just to make sure that you're in your own comfort zone of
your own element
of risk and reward and probabilities and sleep at night. You know, don't put yourself in a position where if things don't go the way you want them to go, it's going to be a problem and you're going to want to do something.
Absolutely.
You know, don't even go there. That's what do I do?
You don't open the trade, it can't hurt you.
What do I do now is the question that I get. And my question back to them is, my comment back to them is,
back up to what should you have done back when you put the trade on.
Can you rewind the clock? No. Well, it's too late. You can't fix. There's no fix button, right? Contrary to some belief, there's no repair. You just have to move forward, right? The real answer is don't put yourself in that position.
Don't do it.
Just don't do it.
Right. So back to risk and reward. The thing we want you to see is that options allow you to choose the risks you wish to take. That's one of the most powerful benefits. Now you can reduce or eliminate the risks that you don't want to bear, and you can actually seek out risks that you're willing to take in exchange for greater returns.
Yeah, you
can.
But
none of this could be done, at least successfully, if you don't understand the risk-reward connection. So with that, Stu, let's see if they got the answer here. 2 30-day vertical spreads, same stock. Everything's the same, right? It's a $5 payoff. We can tell that because of the risk, the payoffs here, they add up to 5. Pay 4 to make 1 is one of the vertical spreads. Pay 1 to make 4, which is riskier. Now, hopefully everybody out there now sees that the pay 1 to make 4 is riskier. It's an out-of-the-money spread, which is why the market bid the price down and left you with a very high reward. Both of these have a $5 payoff.
And
they're $5 spreads.
Let me note that the out-of-the-money 1 to make 4 spread is not it doesn't make you a bad trader to do it.
No, it's not wrong.
It's not that at all. That's got nothing to do with it. It just means that you have to realize that in order to get that pay 1 to make 4, you have to take more risk to do it.
Right.
That's all it means.
Correct. Where it does become a problem is if you say, I chose this one because it has less risk.
Yeah, that's
because I'm only risking $1, and by the way, I can also make 4. Well, no, the reason for that relationship is that it's super high risk. Now, why did the market bid this up to 4? That's getting more towards the guaranteed game. Certainly not guaranteed, but it's more in that got a much higher probability. The market says, I'll bid 2, 250, 3, 4, and pretty soon they pushed it up to 4, and that left a $1 reward. And the reason they did that is
go ahead, sorry.
It's a high probability.
People ask yourself, like, why do deep in the money options have very little extrinsic value?
Yeah, because there's a high probability.
Answer that question. Why? There's got to be a reason. Why do at the money options have the most extrinsic value?
Because it's a coin flip. You're right there on the edge.
There's got to be a reason, right? That's where we want you to go. Just think about the reasons that deep in the money call has very little extrinsic value. Why? Think about it. Why? If it's the insurance thing, what are you actually insuring? it's so far in the money that what are you actually?
The chances for it to fall out of the money are so slim. People are like, I'll give you an extra 50 cents or an extra 75 cents for it, but they're not, because it's an implied put. We talked about that many times before. Calls or puts, puts or calls. Deep in the money calls are the same thing as stock with a super far out of the money put option. Well, it doesn't have much value. And now we can use that to our advantage to do maybe a stock replacement strategy. But it all comes down to understanding your options, understanding your strategies, and hopefully now understanding your risk and reward. So I hope that helps. Stu, thanks again for being here and helping out. I think we got to get Scotty on next week, and we'll look for all of you next week on Coach's Corner Thursday at 4 p.m. and we'll see you then.
See ya.